Chris Finefrock is the Senior Vice President of Financial Planning and Investments. Chris oversees and is a resource for the team responsible for all aspects of the design and implementation of various brokerage, insurance, and advisory solutions, which assist investors with risk management and reaching their accumulation and distribution goals. Today, Chris brings us a perspective on what is, I guess, going to be called the new normal in portfolio planning. Let's all give Chris Finefrock a warm welcome. Chris?
Look at this picture, and times have changed, right? My hairline's not what it used to be. The markets aren't what they used to be. Taxes aren't what they used to be. It's all these things. So with that, we have to start planning for the new normal. So when I look at financial planning and I really look at capital markets and taxes and human behaviors and how all of those things go together, let me see if I can get this, dude. There we go. Okay. So how all of these different things go together, it really comes to mind that we can only control so much, right? We can't really control what the macro environment is around taxation or around capital markets, but what we can control is a lot of the human behaviors around asset positioning, around risk tolerance, around timing, around spending, around savings. And that's really what we've tried to do over the past 10 years with partnership with our firms, is come up with these different tools, whether those be the modules or comprehensive financial planning tools that really articulate the human behaviors and how they can help a client understand their situation and then what they should do based on some of the capital market environment or the tax positions that they're in order to optimize those things. So today I'm not going to talk about anything new. We're going to talk about some of the bucketing strategies that we have historically talked through, but really look at, are the assumptions that we use for these buckets still the same as they were 10, 15 years ago when the environment was much, much different? So here's the kind of foundation of what we base all of our cash flow analysis on in our financial planning. It's basically the short-term bucket is between 0 to 5 years. We expect 3 to 4% return. We need about 15 to 20% of the allocation there, and we're fairly conservative in that. We'll go through why in a little bit. Midterm, you get a little bit more aggressive, a little bit higher return, a little bit more of the nest egg, and then long-term is really where you're talking about longevity, inflation, those types of things. So you need more equity exposure, longevity protection in order to keep up with those things. You boil this all down, and what's the average solution for a retiree over and above Social Security and pensions? It's a balanced strategy, 60-40. You add those up, you multiply by the historical strategy, you come up with a balanced investment, okay? But I want to take a look at these expected returns inside of this, and then we're going to look at the historical strategy to say, is there anything different that we need to consider within this strategy and returns given what the market situation is? And so we have someone talking tomorrow about equity markets and fixed income markets. I'm not going to go in depth in this, but I just want to do maybe a 10-minute overview of some of the research that our portfolio management team has done, that they've shared with me, that I'm going to try to share with you, that does justice to some of the things that they're looking at, okay? So I'm going to start looking at equity markets and kind of look at the past and look at what the forward looking is and then boil down what can we do from there. So you'll notice this, this slide is very similar to our market risk slide that we have from risk. We update it every year. What it does is we plot on this chart that's a band of returns, 0 to 6, 6 to 12, so on and so forth, on positive and negative market returns in the S&P 500. Bobby Samuelson went back 50 years. We went back 90, just saying. So we like to be thorough in our analysis. And basically what we come up with here is when markets are up, they're usually up fairly big, and when they're down fairly big. Over the past 90 years, our average return is about 11.5%, and our standard deviation has been about 19.5%. Of the market occurrences that we have, calendar year returns, the markets has been 72.45% positive. So I'm not going to go deep into statistics. There's going to be some of that nerdy stuff in here that y'all are used to, but we're going to come back to these numbers to say, what does the forward-looking 10 years look given what the history has been? So we borrowed this information from research affiliates. One of the many things that our portfolio management team looks at when making portfolio management decisions. And what this is a plot of the risk return of different asset classes for the next 10 years looking forward, okay? So plotted here, you can see in dark, you got the US large cap, yellow, it's small cap, all countries, the EFA, and the emerging market, okay? I want you to notice along the bottom axis, that's your expected annualized rate of return over the next 10 years in each one of those asset classes, with the level of risk going up the y-axis. What we'll notice compared to the historical is you're getting a lot less average return for about the same amount of risk. So I want to put this a little bit differently. For my mind, graphically, I like to think of things in bands of probability, okay? So when we look at standard deviation and average return, we can start banding and saying, okay, if we assume that this is a normal distribution, we can say 68% of the time, these asset classes will return something within this black range, okay? So for the US large cap, it's somewhere between a 15% and a negative 12% average return, okay? You go out to 95% probability, you can say, hey, upwards of 30%, downwards of 25%, okay? And so on and so forth for all the asset classes going across. What's really interesting here is the positive 10-year return probability, only at 56 to 67%. So what can we deduce about equity markets? It's still our best upside for growth. If you look everything that's shaded in green, we still have tremendous positive upside, right? But the probability of that upside happening is not what it used to be. So we need to be cautious when we're looking at equity markets. I'm gonna move on and out of fixed income markets, okay? Another really uplifting outlook, as we've heard a little bit earlier today. I think it's best showcased in this one slide. And the reason it's showcased best in this one slide is it overlays the starting yield versus the 10-year forward-looking return from bonds for the last 30 years, okay? You'll see up in the top right-hand corner, it says there's a correlation of 0.86, which means these things move almost in tandem with each other. And so you can see that the light blue line is the starting yield of the treasury, or the fixed income, okay? And the black line is the 10-year return. So if we were to go out here to 2020 and look at our next 10 years of returns using fixed income, what can we deduce about the expected return of that fixed income instrument? It's probably gonna be between 1 and 2%, right? It's happened every 10 years for the past 30 years that it's basically the same as the starting yield, okay? So when we look at that, there's a lot of conversations of, okay, well, we need to find more yield. Our clients can't settle for a 1 to 2% return. So you start looking at different things like maturity, duration risk, going longer out on the duration curve, okay? What's happened in this over the past 10 years is you've really seen this divergence between the yield to worst and the duration. So the yield to worst is basically the worst yield that you can get without the bond defaulting, okay? And then the duration is obviously the amount of interest rate risk associated with it. And so what this actually means is you're getting less and less benefit for the amount of interest rates that your interest rate risk you're actually putting on the portfolio. So you can see the yield per unit of duration has gone down for the last 30 years straight. So taking a more long-term maturity on your bonds is not exactly a great solution anymore either, given this next slide, which really goes into what happens if interest rates move against you, okay? If we're only expecting 1 to 2% rate of return within our portfolio, and we look at how all of these different asset classes respond to interest rates moving outside of the expected, okay? So interest rates move 1%. What happens to US Treasuries? You lose about 7%. Same things with corporates, 5% for the ag, a little bit less for municipals, and then you get over to high yield and those actually go up a little bit. We're gonna talk about that next. So if interest rates don't move a lot, I know the Fed's come out and said we're gonna hold interest rates low for a foreseeable period of time, but low doesn't mean the same. It could go up by 1% and that could still be considered low, right? This is looking at the return associated with a 1% change in interest rates. So you can wipe out 5 years of yield by just interest rates going up by 1%. So it's a little scary looking at that situation. Now let's address the second way that we can look at more yield within an investment portfolio, which is going to high yield, which we can see if interest rates rise, those actually gain value. So let's look at the quality side of the fixed income market. So the quality side of the fixed income market has boomed over the past 10 years. You look at this slide and you can see everything in yellow is basically BBB or lower rated, and you can see that it makes up a higher percentage of the fixed income market today, okay? So it's moved from 37% to 53% is basically BBB or lower credit quality rating. Additionally, the whole corporate debt market has boomed by 233%, since 2010. So lots more debt on the balance sheet and it's a lot lower credit quality, okay? The problem if you put this inside of a portfolio with equities is it erodes diversification, okay? The whole idea of a 60-40 portfolio is that, hey, when equities go down, bonds stabilize your portfolio, you don't experience that type of volatility, right? When stocks go down, what do people get worried about? Default. What happens when things go default? Well, stocks fall to zero, but also creditors start lining up in order to get paid back for the debt, right? And in high yield, the probability of getting paid back for that debt is not as high, okay? So when things happen like volatility, here's showing what happened to all of the different fixed income classes during the financial crisis, and then also just during our most recent little episode of volatility, something called COVID-19. I don't know if you heard of it. So with corporates, you get a little bit of volatility. We've seen that within even the TOPS portfolios, which has a very conservative allocation to corporates with low duration and everything like that. But we saw some volatility within that, not nearly as much as what you see in high yield over on the right. Almost 50% correlated to the US equity market. So you're not getting the same level of diversification if you're using that as your fixed income component inside of your portfolio. So again, I'm not going to go through a ton of slides on the capital market, but I wanted to lay at least the framework. And I thought you guys needed some uplifting news this afternoon. So we talked about equities. We talked about there might be there's a good chance that you want to be cautiously optimistic about equities, okay? The long-term expectation is that they will grow 60+% of the time is what the forward-looking projections look like, but it's a lower clip than what we've seen over the past 90 years, okay? It's still our best solution for long-term growth. Fixed income, as long as you're expecting between 1% and 2%, we know that you're not getting a lot more benefit for duration risk, as well as credit quality. If you're going to use high yield, at least know that you're not going to get the type of diversification benefits when you hit the next rough patch of volatility within the markets, okay? So now that we're here, the question becomes, what do we do about it, right? It's the same questions our clients ask us when we're doing our financial plan reviews, or they call us in the middle of COVID-19 and they say, oh my goodness, what do we do? And unlike an asset manager that would try to justify why we put them in some sort of allocation and try to tell them that, hey, this is the best investment for you, we want to go back to the plan and basically say, how does this impact you achieving your long-term goals? Why did we put this in place in the first place? Was it for the next 6 months or was it for the next 60 years? Okay? And that's the best way we do that, by looking at these bucketing strategies and then correlating the return back to what is the need for this money anyways, okay? So obviously, based on the previous slides, we want to relook at the returns that we're using inside of our financial planning models. If you're using Money Guide Pro, eMoney, make sure that you pay special attention to that inputs tab on how you're looking at capital markets. Make sure you're not using just the purely historical model, because it will paint a more rosy picture than what I think we're all anticipating for the future. And most clients, they want to be told the truth, right? They don't want some rosy expectation that they're 99% on track and then it ends up being that 1% of the time that we didn't think of, right? So look at the returns, make sure they correlate to what that's looking at. And then the second thing is, let's look at the strategies that we're using for short, mid, and long term. And most importantly, what the trade-offs are for taking different strategies within these portfolios. So the first thing I'm going to do is I'm going to talk about the short-term bucket. Definitely not the most sexy type of bucket to talk about, right? In this bucket, I can't emphasize enough that the return of the funds is more important than the return on the funds. And that's because for a 1% increase in returns, you're only decreasing the nest egg need by about 0.5%, okay? You're not getting the benefits of compound interest here. So you're really looking at conservative, stable returns more so than aggressive returns. So we always talk about market and sequence of returns risk. They're the two pillars that we started the risk process on, and this is why. Because that short-term bucket, you don't want to be susceptible to that sequence of returns risk. So here we have a table that basically shows how much capital is needed. If we were building a financial plan, how much capital do we want to put in the short-term bucket in order to provide a $100,000 income stream for that bucket, okay? So from 0 to 3 years, obviously a 0% return, we need $300,000 in that bucket, okay? But for every percentage that we go up, you can see that the amount of money that we need in that bucket doesn't dramatically change. So just make sure that we're talking through this with clients when they're like, oh man, I can only get 1%, or the money market's only yielding 0.5%. That's okay. It's okay. You'd rather see that than the market decline by 5, 10% or something like that within the short-term bucket, because that can start blowing up a lot of the strategy that you put in place. So what do we get, or what are we really looking at for this short-term bucket? Short duration bonds, a lot of what we use in TOPS, those are okay. They're very stable. There's not interest rate risk. There's not credit quality risk. What you see is what you get, that type of thing. Okay, cash equivalent fixed income interest instruments, and then even certain only SPIAs. If your short-term bucket, you want someone that's very regimented and they will just want to know that it's going to happen and the paycheck's going to just come to them monthly. Certain only SPIAs, you can structure them for 5 years. They're not crazy attractive. You're thinking between 0.5% and a 1.5% yield on those, but at least you know that bucket is taken care of, and then you can focus on the 5 to 10 year out bucket instead of that short-term bucket. So nothing super sexy there. The midterm bucket is when we get into some more creative options, and it's because for every 1% return, now we're starting to see a little bit more compound interest coming into play, where you say a 1% increase in return, now we have over a 2% decrease in nest egg that we need. So we can see years 4 to 10 using a 3 to 7% return, how much money we need inside of that bucket to fulfill that income stream from those years. So let's just look at kind of the problem with a traditional balance strategy within the midterm bucket. Well, we just went through the starting yield, and that was as of August, so it's fluctuated a little bit since then, but the starting yield is pretty much synonymous with what the next 10 years is going to hold, right? So if that started at 1.03%, we know that 40% of our portfolio, we really can't count on more than 0.13% for, right? And if we're targeting a 6% rate of return within our portfolio, what does that mean we're expecting from the equity markets, okay? So a little equation over on the right-hand side, we got 40% times 1.03% yield gets 0.41, which means we're expecting 60% of our portfolio to yield 5.58%. You do a little arithmetic and you figure out, I need equities to return 9.3%. Where in the chart earlier did we see equities returning 9.3%? We didn't, right? We didn't. So we have to challenge historical assumptions around using a balanced portfolio with a 6% return, either use 5, 4% for balanced, or we have to start looking for alternative solutions. Bobby mentioned this earlier. He called them structured products. We call them Swan Investments. They're the same thing. Swan stands for sleep well at night, okay? They're traditionally what we would think of bonds as. They're the stabilizing force within our portfolio that will give us more predictable outcomes, mostly on the downside, right? Mostly on what we worry about. We know we won't lose any more than X amount, or the first X amount of our portfolio will not go away, okay? So we look at these investments not as an equity alternative, but as a fixed income alternative, okay? They're linked to upside. Bobby mentioned all of the crazy indices that have come out. Jess and Larry have written articles on the crazy indices, these exotic indices. We don't subscribe to those. There's also really good indices called the S&P 500, the EFA, and the Russell 2000 that are available in these types of products that are much more predictable, and you don't have to read a 6,000-page manuscript to figure out how they actually work. So we believe in these sleep well at night investments. that are both structured as buffers and floors when linked to an actual indice that has a predictable track record. And over on the right-hand side, how buffers work is basically the insurance company will eat the first X amount of downside, and then the client is on the hook for the rest. A floor is the exact opposite, where the client is on the hook for a predictable amount of downside, and then the insurance company will cover any additional amount. The other innovation is it's not just the annuity space that is actually getting these Swan type of investments. Well, traditional brokerage annuities have them, advisory annuities have them if you only work in the fee space, or there's ETFs coming out and that are already out that subscribe to this same type of structured type of investment. So through Valmark, you have options of quite a few reputable companies that you hope won't change the rules after, as well as the portfolio management team. We're talking more about a partnership with Wisdom Tree, where we're actually going to have a very similar structure that's available in an ETF versus packaging it into an annuity and having the same type of floors and some really interesting things that I believe that we're going to have a webinar in December on. So look out for that. But it's the same type of investment that we always talk about with these Swan investments. So just to go through how these Swan investments can look, because Bobby said, hey, there's a number of different ways that you can basically structure these types of Swan investments. Here's two of the more popular ones. One is basically Nationwide's best, and the other one is more of Lincoln's best option that at least we see from a utilization standpoint. One subscribes to the buffer methodology, one prescribes to the floor methodology. They work a little bit the same way. So Lincoln's is you lock in for a 6-year period, okay? And over that 6 years, if the indice is down more than 20%, then you start eating the losses, okay? They're gonna cover the first 20% of the losses. Nationwide is a little bit different. It's a 1-year product, okay, or a 1-year lock-in with a 10% floor. So if the market's down more than 10%, you're always gonna bottom out at 10%, a lot like what a balanced portfolio has traditionally been, okay? If the market is up, you're gonna get a 70% participation on the upside with a 1.5% spread, okay? So the spread is essentially you're buying a little bit more upside. They also offer another one where you basically get about 60% of the participation rate, but there's no spread. And so you can run a bunch of math and figure out exactly what equity markets will make one of these the best, but here's a back-tested model using a real indice instead of one of these fabricated indices using the S&P 500, okay? You can see over the past 12 years that the Lincoln type of solution would have yielded about 6.79%, Nationwide about 5.87%. Isn't that a lot like a fixed income return that we've expected historically? Yeah. So over the long term, what we're expecting out of Swan investments, knowing that the capital markets aren't the same as we'd traditionally be thinking of, is look at these for a 3.5% to 5% rate of return, okay? Usually you're looking at bond returns plus 2 to 3% at the very maximum in these, because underlying you're just using some options and things in order to create some of this upside. So you can't just fabricate it out of nowhere, just like Bobby kind of talked about in his AG 49 conversation a little earlier. So if we look at restructuring our balanced type of investment for this midterm bucket, and instead of putting 40% in fixed income, we put 40% into a Swan investment, and we're expecting 4.5% return from that. Well, now we're talking about 1.8% instead of 0.4% coming from that fixed income component or that Swan component. Then what are we expecting from equities in that? Well, we got 60% of the portfolio that needs 4.2% of the return, which equates more to a 7%, which is more in line with what the forward-looking expected equity returns look like. The last bucket that we have is the long-term bucket. And you can see the compound interest associated with the long-term bucket, how important it is that we get the higher yield, because it has it means a ton of difference to the outcome of the portfolio. And you can see we got the Albert Einstein favorite quote about compound interest there at the bottom. And so when we look at long-term equity markets, what was in that band of 4 to 8%? Well, we had the all country, we had small cap, we had EFA, we had emerging markets. we're not saying large cap won't perform. We're just saying based on valuations and what the experts are saying, they say it doesn't have as high of a probability, but that's where, the whole risk return thing comes in. So looking at that, a well-diversified investment portfolio obviously makes a ton of sense to fall somewhere between the 6 and 7% range. The other long-term vehicle that we talk about is more on the longevity protection side, where we're still looking for the same rate of return as we would within a growth portfolio, right? The growth portfolio, we just said we're looking between a 4 and 7% rate of return over the long term. Well, this is the IRR, or the internal rate of return curve, of a deferred income annuity. We've been talking about deferred income annuities probably since 2012, maybe. We've written white papers that have gotten published. And I can tell you, even though interest rates have gone down, the IRR on a correctly structured longevity protection annuity has not really changed that much. A lot of people think that all SPIAs and things or fixed income annuities are tied completely to interest rates, and that's not true. So this is an example of a pure mortality hedge, or longevity hedge, where you are actually purchasing the annuity with a lump sum of money, and it doesn't actually kick off income until you're 85, okay? So most of this is mortality driven. You're talking law of large numbers, where you're actually putting your money in and it's producing an income stream that will yield a positive IRR out in the future. And you can see it hits about 4% between 90 and 91, and then gets closer to 6, 7% by the time you get out to age 100. So you're trading standard deviation inside of equity markets for mortality risk from a risk return trade-off, but it's basically achieving the same type of return as what you would have previously looked at from a fixed or from an equity market. So in total, let's look at the summary here. I like to look at it visually like this. Some people like to draw buckets and fill them up with different things. We like to do cash flow planning, right? It's what our entire model is built on, whether it's risk, whether it's ARC, whether it's the estate planning. This looks very similar to one of the pages within the risk output. And so for the short term, we're still looking at conservative allocations, certain only SPIAs. Remember, the return of the money is more important than the return on the monies in this, and that's that light blue there. The midterm bucket, balanced allocations are okay as long as you're using correct rates of returns. Look at Swan Investments if you're not super excited about fixed income returns being in the 1 to 2% range. Growth portfolios, still the way to go within the long term. Look at deferred income annuities if you want to trade off some of the standard deviation or volatility risk of equity markets for some longevity if that individual has longevity in their family. And of course, at the bottom, you have all of your other cash flow planning things like living benefit riders on annuities, pensions, Social Security, and those types of items. So I really challenge you to call the financial planning team. These guys are fantastic. We've really ponied up, and we've gotten a lot more resources and tools out there in order to showcase all of these different concepts, however you might want to show them, either in a one-off design or within a comprehensive plan. So just tell them that you want to see whether that's a longevity income guarantee, or you want to reduce the rate of return assumptions, or whatever that might be for the market new normal, and they'd be happy to facilitate through whatever planning process that is fit for the situation.